welcome to today's webinar. My name is Zaheer Anwari, co-founder of Sublime Trading. Before I jump in, could I just get a quick screen check and mic check? Make sure that you can hear me okay and see me okay. You should be able to say hello in the chat box or put your hands up to let me know. I think in your panel you should have a little section where you can put your hands up. Right, fantastic. Okay, fantastic. All right, brilliant. Okay, hope you're well. Friday, end of the week, and hopefully a strong end to the week with what I am going to show you today. I've only just started my partnership, my relationship with ActivTrades. This will hopefully be the first of many webinars going forward. So it's all about unleashing your investment potential. And today I'm going to be sharing my 3-step stock market advantage blueprint and how we can build a successful portfolio using these 3 steps. So without any further ado, guys, let's dive straight in. What I'm going to do is start with a set of slides that'll probably go on for about 20-25 minutes. Then we'll move across to the charts, do some analysis together, and then finally we'll end up with any question and answers that you may have. Okay, so let's set the stage, guys. What I'm going to share with you today, to a certain extent, you may already understand. Often people sort of deviate from proven rules and a proven understanding of how to invest, particularly with all the sort of promises of get-rich-quick schemes and quick trades and short-term trades out there. There is a process that we've got to stay true to. Hopefully you've not seen it presented like this before, because the industry has evolved. We've got technology, our understanding has got better. As retail investors, we've got better. So I'm hoping today is something new, it's updated, it's relevant for you as a private investor or a private trader. And this is really key, guys. It's usually the simplicity and the repetitive nature of good investing that tends to elude people. So we're really going to drive home that process. In the boxing world, I don't know if you guys out there, if you box, in the boxing world, we say drillers make killers. Drillers make killers. So it's that repetition of the same punch again and again and again and again that makes it so effective. I think it was Bruce Lee. Was it Bruce Lee or Muhammad Ali? I can't remember. One of them said that he fears the man who's practiced one punch 1,000 times rather than 1,000 punches one time. So it's really that repetitive nature of keeping it simple and practice and repeating that makes good investing so powerful. Okay, so but those who grasp it, guys, and stay consistent are very handsomely rewarded. And I think this is a key point. It's the persistence and the consistency of applying proven rules where the money is. Often what tends to happen is that people bounce around from one short-term strategy to another, and they don't really get anywhere. What you want is to understand what works and then run with it for 1, 2, 3, 5, 10, 15, 20 years, effectively for the rest of your life. And that is where the rewards are. Okay, so let's start with this question. Agree. The goal of any stock investment, really any investment, but stocks is really what we're going to focus on today. The goal of any stock investment is to buy a stock at a determined price and sell it as high as possible for maximum profit. I'm going to say that again. The goal of any stock investment is to buy a stock at any determined price, and sell it as high as possible for maximum profit. We should hopefully all agree. I can't see your screens. I can't see your faces. I'm going to just check if there's anything coming through. But ultimately, I'm just going to accept that we all agree on this as what good stock investing is about. Now, there are 2 ways that we can do this. One is the buy low, sell high methodology, which is better known as value investing. Warren Buffett has made this approach very famous, very popular. And then we've got the trend following approach, which is buy high, sell higher. So value investing is looking at stocks that are heading down, finding a level where you think it won't get any cheaper, and then start working its way back up again, buy low, sell high. Trend following is buying a stock that's already going up, finding an entry point, and then riding the journey up. So here's a question. Which approach has a proven history of being more profitable? Again, I can't see your faces. out there. I did this on Saturday. I was invited to do a presentation live on Saturday, and I asked this question, and luckily most people agreed with the idea that trend following has a proven history of being more profitable. But here's the thing, if you go online, our social media channels, if you're in the investing and the trading space, it doesn't take long before you see faces like Warren Buffett pop up and the 50 rules of Warren Buffett and why Warren Buffett is so successful. We're constantly bombarded with Warren Buffett. Now, don't get me wrong, he's a great man, he's achieved great things, but his approach of value investing is not actually that powerful for us as retail investors. A lot of people are focusing on growth, and growth stocks in terms of trends is really where the money is. Now let's look at this in terms of facts. Here's a performance table. If you look at the top of the performance table, Richard Dennis, right at the top there. If you're not familiar rather with the turtle trader experiment, I would highly recommend reading Way of the Turtle by Curtis Faith. It's a true story of how everyday individuals were taught to trend follow in a matter of weeks, and over the next 4 years they turned over millions, hundreds of millions of dollars. True story. It was set in the 80s. The book is Way of the Turtle by Curtis Faith. Jerry Parker, there was an interview with him recently on YouTube. I recommend watching that interview as well. If you aren't familiar with the turtle trader experiment, guys, I would highly recommend getting familiar with it, because when I came across that book in 2006, 2007, it completely changed my whole approach to the market. Now, let's have a look at the people that we do tend to hear a lot about. Charlie Munger, Warren Buffett, Benjamin Graham. These guys are mid-table. So you have to ask yourself, why is it we hear so much about mid-table investors, but we hear very little about top-tier traders that hardly get any attention, hardly any mention in our media channels? You have to always question. One of the things that I always say to people is question and go and find your answers. Don't take what you're given at face value. When I came across Richard Dennis, as I said, in 2007, everything changed for me. Now, it's the simplicity of trend following, learning, execution, and compounding that simply cannot be beaten. If you compare trend following to value investing, trend following has the edge. And it's the simplicity, as we've already mentioned, that most overlook in preference for more complicated investing and trading methods. There's an expression in the trading world, in the investing world, which is good trading, good investing is simple, but not easy. The best techniques are simple to learn, simple to execute, but what makes it difficult, and as I said, where people tend to fall short, is that they give up too quickly. When they don't see returns or success in the first week, 2 weeks, month, whatever, first year, they tend to give up. And that's a big mistake. You have to be consistent, and that's where the returns are. When I discovered trend following, it completely revolutionized my portfolio performance. Now, a question I asked myself was, why aren't information and hype on trend following readily available? This was something that I asked myself back in 2007, 2008. Why was there nothing out there? So I made it my mission to put trend following back on the map so that I could connect with people like yourself and give you a process that you can run away with, and that will give you the confidence and the peace of mind that your financial future is where it should be, which is ultimately in your hands. You want to be in control of your growth of money and where, in which direction you are heading. If you keep giving your money away to tracker funds and leaving it in a bank and underperforming professionals, there'll only be regret later in life. And that's not the world we live in today. The world we live in today gives you control. We've got online brokers that are tax-free here in the UK, ActivTrades, who are hosting me today. They offer spread betting accounts. They're free of capital gains tax. Why would you not want to learn to use them correctly? Because the money is in your control and it's free of capital gains tax. People do gravitate towards spread betting accounts, but they don't know how to use them. That's why they have really bad reputation. But ignore what the rest are doing. Focus on the people who are learning to use it correctly and mimic. There is no secret here. Learn to do what works. So just a little bit about myself, guys. Now, I want you to understand something about me. Up until university, I would categorize myself as an underachiever. At school, I wasn't great. At university, my degree, I got a 2.2. For those of you guys here in the UK, you'll understand that a 2.2 is one off the bottom. The worst you could get is a third. In fact, the worst you get is a fail, I guess. But you get a third and then a 2.2. So my education, if you like, growing up, there wasn't anything particularly remarkable about me. I was a bang average student. Teachers always said that I wasn't living up to my potential. And as a matter of fact, I struggled so much in school, I felt like a misfit. Now, here's the thing, guys. It's because of this growing up that I am where I am today. I knew back in school, even in my early days, I'd question everything. And teachers didn't like that. Didn't make me a bad student. I just didn't like what was being pumped at me all the time from a very, very young age. And so that made me a little bit rebellious, made me, if you would like, a bad student in the eyes of the education system. But ultimately, all I did was question. After university, I never worked in the city or for a hedge fund. In fact, I've never worked in finance at all. I've got a degree in software engineering. I worked for a year for Oracle Corporation during my university days as a placement year. I absolutely hated it. When I graduated, I became a TEFL teacher, which is teaching English as a foreign language. I lived in Asia, Taiwan, Japan, the Philippines, teaching English. When I came back, I got into photography, which was always my passion. Advertising photography is what we did as a collective. That's where the money was. And often I was working 6-7 days a week, teaching English at the weekends and in the evenings. And then photography was my main 9 to 5. One thing I was good at, guys, is A, making quick decisions if I didn't like something, and B, making and saving money. So by the time I got into my mid to late 20s, I'd already saved up a pretty decent amount of money compared to a lot of young 20-year-olds. And it's because of that war chest of money that I had saved up that I then wanted to sort of learn to invest it and trade it. Of course, you know, your family will generally want you to do things that they are familiar with, buy a property, for example. That didn't resonate with me. I wanted to learn to invest and grow my money. Whenever I did my research, I always understood that financial market investors were always at the top of tables. They were the ones making growth. Even business owners, when they make profit, they funnel it through the markets. So I always gravitated in that direction. Started day trading, it didn't work. Started value investing, again, too slow, it didn't work. Too much work. I was working a lot of hours. Trend following. When I came across that, everything changed for me. My point is this: there's nothing remarkable or special about me. It's just that I asked the right questions, and because of that, today I'm now a speaker. I'm a contributor to all of these wonderful publications. As I said, ActivTrades as well. Recently have partnered. We've partnered together. This is my first webinar, so my message is getting out there. People over the years have paid attention to what I'm saying. They've given me a platform to get my message out there. I'm also now the co-founder of the Phoenix Academy, which is our main education academy, Sublime Trading's education academy. And as of August this year, we had our fund, the Revacy Fund, incorporated in Luxembourg. So for the education is for those who want to learn. The Revacy Fund is for sophisticated investors. Minimum investment is 125,000 euros. These are for investors who don't want to learn, but obviously want the returns that we can get our investors. We've had our track record verified. Of course, you know, you've got to have your track record verified over the last 3-4 years. We're averaging around 30%. So do the maths, guys, and we'll look at that in a second. And ultimately, I've achieved all of this because I've learned to follow and invest in stock market trends, not just in the stock market, but in stock market trends. That's really the sweet spot in terms of what I learned and what I've achieved today. So the question is it possible to get consistent returns from the stock market, returns that outperform the indices from the comfort of home in 60 minutes a week? I'll ask that again. Is it possible to get consistent returns from the stock market, returns that outperform the indices from the comfort of home in 60 minutes a week? And of course, the answer is yes. I've been doing this for over a decade. And this is the 3-step trend following blueprint we created that will help you do it. So let's start with some numbers, guys. Imagine you have a £20,000 starting pot. You know, that's really the kind of starting pot that you want to really run away with this. You can start with less, don't get me wrong, 5,000, 10,000, but 20,000 is that nice spot where you can control your risk and really spread your money across good opportunities. So let's say you have a starting pot of 20,000. Let's say you want to make $1 million. You can add a further £100 to the pot every month. And let's say that you want to achieve this in the next 20 years. Okay, you've got 20,000, you want to achieve $1 million, you can add a further £100 a month to the pot, and you've got a 20-year horizon to achieve your goals. You are looking at 19.78% annually to achieve your goals. Now think about it, guys. The more money you can put into this, the quicker you will achieve your goals in terms of both growth and in terms of shortening that time horizon. And again, as I said, it's that consistency. Once you planned it, it's the consistency of sticking to the process. Remember, this is on average 19.78%. There'll be some years you make 100%. There'll be another year you may make a 5% loss. It's that consistency of maximizing trends during booms and protecting your money during downtimes, year in, year out, which is where the growth is made. What tends to happen is that people are chasing 5% a month consistently every month. That will never, ever happen. There'll be people out there who promise you that and tell you that can happen. It will never, ever happen. As I said, ask for a track record. Ask for a proven track record on a live account. If people can't show you track records, then you have an idea of the sort of caliber of individual you're dealing with. So let's start with these numbers. Now we can reverse engineer the process. That's the beauty of doing this calculator, this calculation rather, is that you can reverse engineer the process. So banking system, less than 1%, forget it. S&P 500 tracker fund, 7 to 11% a year. Not a bad starting point, better than the banking system. But remember, with tracker funds, you're giving your money away. Hedge funds, 5% to 15% a year. These are sort of your traditional hedge fund. We at the Revacy Fund, we're using CFD technology. We get that 30% a year. We're outperforming. We will outperform. We've got a track record that outperforms a lot of hedge funds out there. Real estate, 10 to 11% a year. Wine, whiskey, 13 to 14% a year over the last 15 years, which is really interesting. Of course, you've got to know about your wines. You've got to know about your whiskey. I've got a friend who works in the whiskey business, and it's phenomenal. The investments and the returns that whiskey can make. And here's the thing, guys, trending stocks, over 30% per annum over the last 10 plus years. I have always focused on trending stocks. I've never really looked at anything else. I'm not a property investor. I've got the one property that I live in. Never really given my money away to tracker funds. Hedge funds have never really interested me. Now they do, because of course I've got my own hedge fund for the sophisticated investor, and I've got a process and the technology that can outperform a lot of hedge funds out there. So we are in a very unique position here. But as I said, I've always focused on trending stocks simply because of the simplicity of execution. I've done it from home, the technology involved, and the returns. Ultimately, if it all boils down to one thing, guys, it's simply ROI. Nothing else matters. So let's do some maths. Excuse me, the numbers here are in dollars. They can quite easily be converted into pounds. But let's go back to the calculations. Let's say we have that 20,000 starting pot. We're investing over the next 20 years. We're adding £100, $100 further to the pot. With the tracker fund, you get 11%. With individual stocks, trending stocks, let's say you get 30% on average. That's not a bad return. 20,000 to around $250,000 over 20 years. I mean, look, the banking system is not going to get you that, right? The banking system's an insult. However, here's the thing, guys. A 30% return over 20 years annually, you're looking at over $4.5 million. That's a significant difference between just giving your money away and having a set and forget style of investing and learning the process and executing a strategy in the right broker account over a 20-year period. And I mean, you're looking at millions. So it's a completely different ROI by simply putting in some legwork and learning and understanding how to do this. So what do all good investors have? The answer is an edge, right? Excuse me, I jumped across too quickly. What do all good investors have? The answer is an edge. Here's the thing, guys, right? What is an edge? An edge is defining high probability environments where you have more chance of making a profit than a loss. Okay, what is an edge? It's defining high probability environments where you have more chance of making a profit than a loss. Here's why an edge is critical. If you cannot define your edge, you don't have one. And if you don't have an edge, you will get eaten by someone who does. Let's go through that again. Here's why an edge is critical. If you cannot define your edge, you don't have one. And if you don't have an edge, you will get eaten by someone who does. For retail investors, the most prolific way to identify an edge is technical analysis. That's using charts on the higher time frames, monthly, weekly, and daily, to efficiently compound and maximize ROI. So effectively, think about it, guys. This is a hybrid approach. You're using charts like a trader on the higher time frames So you're holding your positions like an investor to maximize your return. So that's the sweet spot, combining technology and looking at charts like a trader, holding and compounding your positions like an investor for maximum ROI. Notice the time frames, guys, monthly, weekly, daily. I'm not going down to intraday time frames. Too much work for losses, ultimately. On the higher time frames, you take fewer positions, you hold more, you compound, and you grow accounts. You have to stay true to the processes that work. So when I understood an investor needs an edge and technical analysis to identify trending stocks, I created this 3-step blueprint I'm going to share with you, and my portfolio performance exponentially improved. So the 3-step blueprint, guys, is your edge. I'm going to say that again. The 3-step blueprint is your edge. So let's get into this. Step 1, when to invest for maximum ROI. Understanding market conditions. This is step 1. Simple. Use the S&P 500 and combine it with the 200 simple moving average. So this is what the chart looks like. You see the black line going across the line of the charts. The black line is the 200 simple moving average. The chart at the top is the weekly. The chart at the bottom is the daily. So here's a quick history lesson, guys. Old school traders used to draw charts by hand. So they were very, very particular with the information that they put on their charts. What they found was that the 200 simple moving average was a proven indicator of the long-term trend. So if assets were trading above the 200 SMA, they take long positions. Below the 200 SMA, they take short positions. If there was a mixture, they would stand aside. So I like to look at the weekly and the daily. We move to the next chart just to reiterate this point. If in a bull market, I want to see assets trading above the 200 SMA on the weekly and the daily. If we look at bear markets, we want the market to be trading below the 200 SMA on the daily and the weekly. 2007 to 2009 is a good example of the last real bear market that we had. And then if we have any other combination, we tend to stand aside. So when the markets are bullish, we take long positions. When the markets are bearish, we take short positions. If there's a mixture of time frames above and below the 200 SMA, that's when you want to be standing aside and protecting capital. Now, here's the thing, guys. Be aware that when the stock market is going sideways, where's the money gone? And that's when you may start seeing opportunities in commodities and Forex. So it's always good to have a global view of the markets and then move to where the money is. Now, here's a table, guys. I've gone back to 1990. If you look at the bottom there, since 1990, we've had around 23 years of bull markets, only 4 years of bear markets, and 6 years of sideways markets. So we've had more sideways markets than bear markets, which is interesting because if you go onto our news channel, our media channels, all we ever hear about is that the world is coming to an end. And if you listen to your media channels, you won't realize, or you wouldn't assume or imagine that we've had 23 years of bull markets. There's always a lot of fear mongering, which is why you really want to separate what's going on in the world to your investing portfolio and what's actually happening in the markets. I have this expression, which is Wall Street is disconnected from the high street. So whatever is happening in the world is very much disconnected to what happens in the financial markets. The markets can and will rally despite what we're hearing. Think about it. This year, at the very start of this year, we were pumped with failing banks. You remember that? What happened to that? Failing banks were all over our channels for weeks and suddenly gone, boom. Markets kept on rallying. Then we had the debt ceiling and all that fear mongering around the US defaulting. Markets kept on rallying. Every year there is something in the news that will ultimately keep you stagnant. So we have to ignore that. Now, here's the thing. You do have to understand what's going on in the world because you have to stay informed. You have to be intelligent. You've got to have a good conversation when you're sat around a dinner table. But when it comes to your investment portfolio, you've got to separate the two. Understand that the investor in you is not the same as the human in you. You've got to be completely disconnected. The investor in you has to be 100% robotic, 100% mechanical, 100% subjectivity has to be removed. It's that ruthlessness, which is where the money is, that clinical, being clinical in your decisions and the way you manage your portfolio. That's where the money is. And you cannot be like that if you're constantly being bombarded or allowing yourself to be bombarded with the fear mongering that goes on in the market, in our media channels. So focus on the charts, focus on the S&P in relation to the 200 SMA. Now, once the S&P 500 has confirmed a bull or a bear market, we then scan the markets for opportunities. So this is where step 2 comes in. What stocks to invest in for maximum ROI? This is all about asset selection. I say asset selection because we have to also look at commodities: gold, silver, palladium, orange juice, lumber, whatever whatever comes into that commodity category. We've got to keep an eye out on them. But then we've also got to look at the currency markets as well. There's some wonderful opportunities. I've got several positions running on yen pairs at the moment. I don't know if you guys are following the yen pairs out there, but they've just been going up and up and up. So it's always worth keeping an eye out on Forex and commodities alongside UK and US stocks. US stocks should always make the bulk of your portfolio because it's a mature market. It's where the best opportunities are. So how do you shortlist the best stocks? Well, I have created a 2-tier system. Tier 1, first of all, is I use professional scanners. So I take the 20,000 assets that make up US stocks, UK stocks, commodities and currencies. That's over 20,000 assets. And using professional scanners, I'm looking for those 50 to 500 assets that meet my criteria. I've been using Metastock as my scanner for many, many years. I programmed a Metastock with our blueprint, a particular criteria that we want these stocks to meet. And by clicking a button and allowing the Metastock scanner to go through over 20,000 assets, which can take 5 minutes, 10 minutes, it will then pump out that initial shortlist, because this is tier 1 of 50 to 500 assets. On a quieter days or when markets are pulling back, it will be at that lower end. When the markets are in full boom, it'll be at that upper end of that range. Now, the scanners cost anywhere from around $3,000 to $4,000 a year. Think about it, guys. Every career choice has the right tools for the trade. If you guys think about your careers, I'm sure you're using technology and tools that you would not be able to do your job if you didn't have those tools. If I go back to my time in photography, because we were in advertising photography, our pictures rather, were on the side of buses. So huge, tall pictures that had to be pixel perfect. We were using a Hasselblad camera. I don't know if you guys are familiar with Hasselblad, but Hasselblad really are the godfathers of cameras. People know about Nikon, they know about Canon, which are amazing cameras, but they're not the godfathers. The godfather of cameras is the Hasselblad camera. Hasselblad were some of the first lenses to go to the moon. That was a 60,000 pound camera. Now, we needed that camera to be able to take the pictures, to go on the side of buses, to get repeat clients, all of that good stuff. If our pictures were pixelated, we would have lost clients, we would have lost contracts, and images would never have gone up on billboards and on the side of buses. And that, again, is where usage rights come in. So every month, every year, we were just getting checks coming through from usage rights. So technology is important. The right tools for the trade are important. So Metastock is what I have been using. Now, I'm not saying go rush out and use Metastock. I'm going to show you at the end of this how we do a lot of this stuff for our clients, saving them $3,000, $4,000 a year. Okay, now here's why I need the scanners. Ultimately, there are 11 sectors. I want to be finding the best stocks in the best sectors, because money isn't in, let's say, technology. All we ever seem to hear about is FANG stocks, Facebook, Nvidia, Microsoft, Apple, just the usual stocks we hear again and again and again. But there's 10 other sectors. And some of these sectors have been performing exceptionally well. When we're getting distracted by what's happening in our media channels, all there seems to be talk about is AI at the moment. AI is everything. Just because it's AI doesn't mean that's the stock you want to be in, the sector you want to be in. I go back a few years, cannabis, when the cannabis sector blew up, everyone was talking about cannabis stocks. I mean, the cannabis sector was a complete failure. So we want to look at these sectors, the proven sectors, and we want the scanners to guide us in which sectors are moving. Ultimately, we're looking for the strongest stocks in the most robust sectors. A scanner will help you do that. So ultimately, what tends to happen is a rotation of money from sector to sector. money will stay in one sector for 12 to 18 months, then it will leave, then it will go to some other sectors, then it will leave. So by constantly scanning the market, you're constantly finding which sectors are performing well, and then which stocks in those sectors are performing well. So you understand the logic. First, find the best sectors that are performing, then find the strongest stocks in the strongest sectors. Those are the stocks that you want in your portfolio. Hold for 12 to 18 months and then rebalance. Our job as investors is to find the strongest trending stocks from the most robust sectors. That is our job as investors. That's the starting point of a good portfolio. If you don't have the best stocks in your portfolio, you will never make money. Never. You may have the best strategy, you may have the best mindset, you may have the best risk management skills, you may have all of that. But if you're constantly picking the wrong stocks, which is a common problem, then you will never make money and your portfolio will never gain traction. And here's the tip, guys. The money is in stocks, not in our media channels, right? The wealth, the real wealth is in stocks, not in our media channels. And I'm going to show you some of the stocks when we switch over to the charts. So once I've scanned the market, this is where the second tier comes in, tier 2. I use bespoke charting tools to go through that initial shortlist of 50 to 500 assets that the scanners have picked up. And I'm then looking for the best 10 to 20 assets that make it into my portfolio. I do this using manual analysis. So I have bespoke charting tools that I've created, and I have a checklist system. And I've created all of this for TradingView. TradingView is a wonderful, wonderful charting package, mainly because of its price, guys. I mean, it's like £250 for the whole year. Just to put this in perspective, when I first started investing in 2006, 2007, TradingView wasn't around. I had to pay $4,000 up front for the software that we needed, and then £200 a month for live data. You can imagine that is unbelievably expensive. So, back then I was quite savvy. As I said, I was always good with money and understanding opportunities. I used an interest-free credit card. I paid off that $4,000. The £200 was just coming out of my account. And then I slowly paid off the $4,000 off the credit card before the interest. I think it was like 2 years interest-free or something along those lines. So there were savvy ways of getting set up. You don't have to deal with that. TradingView is £250 for the year. And all the tools that I've developed for that $4,000 package, I now have them available for TradingView. So our community members get access to these tools that I've spent a lot of money on for £250 for the year. It's phenomenal. However, here's the thing, guys. The time commitment to go through this process is roughly 1 to 3 hours every day. At the very minimum, you want to do this at the weekend. Why the weekend? Markets are closed. People don't work. They've got 2 days to find a bit of time, get into a routine, scan the market, get into this process of finding the best opportunities. Once you've done this at the weekend, close your computer, enjoy your weekend. Monday to Friday, you're then prepared for the week ahead. You found the stocks that you're looking at. Every day, at the end of each day, you open up your portfolio, and it takes a few minutes to manage your portfolio. It's a beautiful process. It's something that can adapt around what you guys do. Think about it. You're busy. Jobs, careers, family, married, hobbies, dogs to walk, gyms to go to, all of that good stuff. You don't want to give any of that up. You want to continue with that. You just want to have smart processes working in the background, compounding away, growing your money away. That just takes a bit of weekend preparation and then a few minutes in the week to manage. Here's the thing, guys. I do this every single day, and I do this for my community members. So you can imagine I'm saving them $3,000 to $4,000 a month, a year with the scanners, and I'm saving them 1 to 3 hours every day because I do this for my portfolio. I then share the results with my community members. But here's the 2-tier system: scanners and then charting tools. And that is how I find the best 10 to 20 assets. Notice, no fundamentals, no Bloomberg news terminal, no Thomson Reuters news terminals, no 20 screen cockpit setup. I've got one 27-inch iMac that I do all my work on. Actually, I've got a PC as well because the scanner is only for PCs. So I've got a PC where I do the scanning on, but ultimately all my analysis and portfolio management happens on a 27-inch iMac. Now, here's what my bespoke charting indicators look like. I have 6 on the monthly, 4 on the weekly, 6 on the daily, 16 indicators I'm looking for. When those indicators are met, I then take a position. So in the bottom right, I have a chart that provides me with my entry points, my stop losses, my compound levels, trailing stop losses. I have that all on the chart. So I've got everything set up. No guesswork. there's no subjectivity. All the guesswork is removed. Very mechanical, very robotic, proven with those returns as well. Hence why, again, we have a hedge fund that follows the same process. What we teach our community members is the same process that we use for our fund. Now, here's what my checklist looks like, guys. Remember, again, you've got to have an edge. An edge is being able to define high probability assets where you have more chance of making a profit than a loss. If you cannot define your edge, you don't have one. This checklist is a proven edge. If an asset meets this checklist, it's high probability. If it doesn't meet this checklist, it's low probability. If it meets it, I take a position. If it doesn't, I stand aside. Simple as that. Now, ultimately, what am I looking for? I am looking for trending stocks that are outperforming the S&P 500. So let's think about it, guys. The S&P 500 is an average. You have some stocks that match the average. You have some stocks that underperform against the average. There are some stocks that outperform the average. These are the stocks that we want to scan and shortlist in a bull market. Stocks that are outperforming the market. Typically, I hold those for 12 to 18 months. I just reversed the process in a bear market. The last time I shorted the market was in 2007, 2008, when we had the last a true bear market. Since then, I've only been bullish because the market overall has been bullish. But in a bear market, I would look for stocks that are weakening quicker than the average. Again, still holding for 12 to 18 months. This is an in and out, not 12 to 18 hours or 12 to 18 weeks. We're talking months here. Taking fewer positions, holding and compounding. That is how you achieve phenomenal returns. So again, just to remind you guys, a recap of why I like to do this, because ultimately, when I have this process in my control, it's that 4.5 million that you want to be aiming towards with these sort of returns. Okay, now ultimately, guys, during the scanning and the analysis and that two-tier system, what I'm looking for are stocks that follow this process. It's what I call the 4PS method. You know, you may have heard of things like Elliott waves, for example. The problem with Elliott waves is that they're too subjective, and as I said, we've got better techniques from yesteryear are outdated. Everything evolves. The investing space is no different. It's evolved. We're better now. We're savvier now. We know exactly what to do and what to look for. Technology has really helped us. So this is what I look for with stocks. Phase one, a proven performance. I look at the history. If the stock has performed well in the past, it's very likely to perform well in the future. I then look for a consolidation base. So I'm looking for a stock that's performed well in the past. It's now going sideways. Think of it as the roots of a tree. If a tree has strong roots, it will grow big and strong and tall. If the roots are weak, the tree will grow and at a certain point it will collapse. So we want a consolidation base, usually of at least 3 to 6 months. That's the very minimum. I'm then looking for a breakout. Once the stock is confirmed a breakout, it's phase 4 that I enter into, and this is the one that lasts about 12 to 18 months. With the scanning and the analysis that I do, phase 1, phase 2, and phase 3 actually becomes quite simple. That's where that 1 to 3 hours comes in every day. And then phase 4, that's when those stocks make it into the portfolio. And that's where manual management comes in. I manage my portfolio manually. It's not a robot. It's not an EA that's in and out for me. The best combination is technology to do all the hard work, all the mundane stuff. But when it comes to picking the final stocks and managing them in your portfolio, that's where human involvement, human management comes in. So that's the perfect combination. Okay, pro tip, investing is not about buying and holding forever. It's another fallacy people buy into. Hold stocks when trending, exit stocks when reversing, move between the cycles of trends across sectors, rebalance the portfolio every 12 to 18 months. So it's that medium term hold, which is the sweet spot. Short term doesn't work. Long term actually is too slow. And again, you know, think about it. You could hold a stock like PayPal. Imagine PayPal, guys, if you've seen PayPal. You hold that, hold it. PayPal's down like 80%. When is it going to go back up? We have no idea. So you're better off holding it during the boom. When it reversed, take your profit, move to another stock. Once PayPal sets up again, go back to that. And if PayPal may not set up for another 5 years. So it's no point holding a stock forever. Hold it when it's trending, cut out of it when it's reversing. 12 to 18 months is a good sweet spot. So once we've shortlisted the best stocks and assets to invest in, step 3, how to invest in these stocks for maximum ROI. So this is strategy execution. So step 1, market conditions. Step 2, asset selection. Step 3 is strategy execution, how to maximum ROI. for maximum ROI. So what does it involve? Trend following, entry points, because you want to maximize profit, stop losses, you want to keep your losses small, risk management, never blow an account, compound levels. Now this is crucial. Add more of a winning stock at strategic levels to accelerate profit. Only ever add to winning positions. Only ever add to winning positions, never to losing positions. And then exit management. Trailing stop losses are the perfect way to manage your stock and remove emotions. Think of it as a safety net, guys. Imagine you're climbing a very tall ladder. If you've got no safety nets, no net, you don't want to be up that ladder. But if you're climbing a very, very tall ladder, ideally you want to have a safety net at the very bottom, at the very minimum. But the perfect safety net would be one that follows you by your feet as you're climbing this extremely tall ladder. So at any point you fall off or you decide to jump off, the safety net is right by your feet. That's a trading stop loss. It's a trend as it's developing. It's following the trend, locking in small bits of profit. But here's the thing, there's a key, there's an art to a good trading stop loss. You don't want to get stopped out on every pullback. It's got to be wide enough to allow the trend to develop over 12 to 18 months. But when it is hit, the trend is reversing. So there is an art. Everything, there's sophistication to this that people tend to overlook. It's simple, but it's still sophisticated. As Leonardo da Vinci said, simplicity is the ultimate sophistication, right? Okay, so the perfect combination, a simple to learn and execute trend following strategy, a dynamic broker account like ActivTrades, which is free of capital gains tax. But when I say dynamic, I mean broker accounts give you every single asset that you want to invest in. This is what's beautiful about ActivTrades. Their broker account has every stock you could potentially want to invest in. If you're limited in stocks, let's say you just have indices and a few UK stocks and some commodities, you're missing out on a whole wealth of opportunities. So you want a broker account that gives you access to everything, and you then want to move to where the money is. Mantra: cut losers short, let winners run, and compound. And compound to winning positions only. So this is the perfect combination. You want a simple to learn and execute trend following strategy. You want a dynamic broker account that keeps money under your control and gives you access to every single asset, and that's free of capital gains tax, and that allows you to manage your stop losses, your entry points, all of that good stuff. You then want to cut losers short, you want to let winners run, and you want to compound winning positions. If you get this correct, guys, you will never want to use any other strategy. Okay, the tools, my whole strategy, I've automated. So there's algorithms that go into the entry points, the stop losses, the compound levels. The software, TradingView, again, I've created those tools so that the software is continuously creating these levels and these price points for me. I take these price points and I manually put them into my broker account. Again, I've not connected TradingView to my broker account. I don't believe in it. I think that limits returns. You can end up in situations where you get taken out of positions when you shouldn't have. It's better to manually manage your broker account. So the software, again, is doing all the work for me. No calculators involved. Take those values, put them into my broker account. So how I manage my portfolio: once the S&P 500 confirms the right market conditions and I start scanning and shortlisting stocks, I then need to list and track these stocks. I need to record the entry points, the stop losses, the compound levels, the risk management, the exit management. So I created what I now called the APL. It wasn't called the APL when I created this 10 years ago. It was just a way of me managing my position. But because I share this now with my community members, I call it the asset position log. And this is what it looks like, guys. It's a spreadsheet that has the signal dates. Look at the name of the assets, guys. Look how many stocks that we've shared this year with our community members. How many of them do you recognize? We've got Singapore dollar yen in there. We've got the dollar yen, mostly US stocks. If you look at the market column, which is the fourth one along, the blue, all US stocks. But we've got some currency pairs in there. We've got some UK stocks. We've got commodities as well. The sector, the entry point, the stop losses, the current price. There's a live data feed that comes into this. The strategy we use, whether we're going long or short, how old the trend is. If you look at that column 3 from the right there, age of trend, AOT, you can see it tells our community members how old the trend is. We want to get in as early as possible, you know, in the one of first and second month. And then we're also sharing our risk management, how much we're risking, how many positions we've got. So this is what I call the APL. And this has been instrumental in me being able to manage my own portfolio. And because I was doing this for myself, I then started sharing this with my community members as well. So not only are we scanning the market for them, not only are we creating the shortlist, but we're also giving them our portfolio to copy. So our portfolio is live, it's available for them to look at and then copy our positions in their portfolio as well. So we're doing all the work for them. But crucially, We're teaching them to fish and we're giving them the fish as well. So again, as I mentioned, we shared this process with our community members, the APL in the Phoenix Academy. If you haven't checked out our Trustpilot, we've got a wonderful Trustpilot. There are not a lot of educators out there with a Trustpilot. Do check out our Trustpilot, guys. We've got some wonderful, wonderful reviews, something we're very proud of. And then, as already mentioned, that same process again we will be using for our Revacy Fund as well. Okay, so in summary, the three-step blueprint: when to invest for maximum ROI. This is your market conditions, saving you from missed opportunities. This is step one. Step two, what to invest in for maximum ROI. This is asset selection. We do this, as I said, we save our community members thousands of dollars every year and 1 to 3 hours every day. So that's a lot of time and a lot of money, guys. If you work out your hourly rate at work, you're not having to do that with the stock market here, because we're doing that for our community members. And then step three, how to invest for maximum ROI, strategy execution, improving your performance by many multiples. Our strategy is proven, and ultimately this is what we do for our community members. Step one, step two, step three, which is our three-step blueprint. Okay, so let's switch over to the charts, guys. I just want to quickly go through the just to give you an example of some of the stocks that we have shared with our community members. Just give me a second. Stop sharing. Okay, I'm going to see if this works. I don't know if this is going to work. All right, here we go. Okay, so I believe you guys should be able to see my trading view screen. I'm just going to go through some of the stocks that we have found for our community members this year, and I'm going to go through stocks that you are very likely have never heard of. So JBL, for example, if you look at JBL, since this green line here, which is the high of last year, this stock at its peak moved 91%, so almost doubled in price. It's going through a bit of a correction. September, October, there are correction months, so it is going through a bit of a correction. That's okay, but ultimately this is a stock that has moved significantly since the start of the year. I'm now going to show you a stock that is on our watch list. It's a start of a new trend, just to give you an example. So phase one is that proven history. So you can see this stock has a proven history. This is PGR, progressive. Phase two is that sideways market. So you can see that this is a monthly chart, by the way. If you see from April, let me just get the horizontal ray so you can see for yourself what I'm talking about. There's a consolidation base there between here and here. So between the blue lines, that's a sideways market. And you can see this month, this stock is breaking out, printing new highs. And this is a stock that we are now looking to enter into the portfolio. So PGR is a stock that you want to be keeping an eye out on. McKesson Corporation. Okay, notice, guys, first of all, if you look at this area here, this period here, again, it's a monthly chart. From this red line to this green line, that is a move of 78%. This is the trend of 2022 when the stock market, when the S&P 500 fell 28%. McKesson Corporation moved up 70%. So what does that tell you? There's always stocks that are outperforming the indices. And the only reason we found this stock is because we were scanning the market and we added this stock into our portfolio. Okay, so always rely on the scanners and the system, not on the news channels, because again, if you focus on the news channels, there's not much that you guys are going to pick from that other than stocks that aren't going to perform. Remember, the money is in stocks, not in our portfolio. Now, if you have a look, just going to draw the blue line there again. The market went through a consolidation between the green line and that blue line. Phase two, phase three happened in June of this year, and now the market is starting to push up again. Notice that this stock has been pushing up when the S&P 500 so far this month has been declining. This stock has moved up 5%, roughly 5%, 7% at its peak, but it's roughly around 4.5%, 5% in positive for the month when the S&P 500 is down. So think about it, guys. You've got stocks like this pushing up when the market's going down, and then you have all those stocks that are going down start pushing up as well. Then that is how you really start seeing that compound growth effect kick in. I'm going to show you the Singapore dollar Japanese yen because that is one of the stocks, one of the currency pairs that we've shared with our community members. So Singapore dollar yen, you can see trended between March of 2022 to October of 2022. That's a nice trend. It went through a base. This is the consolidation. Let me just mark the low of that consolidation. And now, if you look at it since June of this year, it's been working its way up. So you can see why we've added the Singapore dollar yen into the APL and into our portfolio. And all yen pairs are doing similar things at the moment. So another, we are in the the dollar yen as well. If you look at the dollar yen, it's been working its way to the upside. It's been a little bit bumpy and jerky, but that's okay. If you look at its history, the dollar yen can trend very, very well. From 2011 to 2015, that's a 4-year trend. We're now looking to see something similar going forward. If you look, there was a consolidation here between 2013 and 2014, and then it went on another run. That's what we want to see here going forward. We want to see a breakout, and we want to see the market start pushing up as well. Okay, so that is the charts. I'm just conscious of time. I'm now just going to switch back to the slides. Just bear with me for a second. Okay, there we go. I'm now back on my slides. Okay, so, excuse me. Where do you go from here? Well, I invite you to join the asset position log. That's correct, guys. The very positions that make it into our portfolio, I invite you to join the asset position log. So what does this involve? Well, in short, we execute the complete 3-step blueprint for you. You just need to copy and manage the final positions alongside us. You understand the logic. I've just gone through it all. I've explained the whole process to you, how the scanning works, how the shortlisting works, the amount of money that goes into the scanners, the time, the 1 to 3 hours every day. We do that all for you. You just need to wait for the notifications at the end of each day, copy and manage the positions alongside us. So step 1, when to invest for maximum ROI, market conditions. We do this for you. We monitor the markets daily and keep you updated, so you know what is happening and not what the media wants you to believe is happening. Step 2, what stocks to invest in for maximum ROI. This is asset selection. We do this for you. We scan the markets for you daily, saving you thousands in scanner subscription costs and 1 to 3 hours daily time you can spend getting on with your daily commitments, ultimately getting on with life, making money, spending time with your family, doing your hobbies, gym commitments, all of that good stuff. You can get on with it. But here's the thing, you're confident that you are in the best hands when it comes to stock picks for your portfolio. Guys, no one's doing what we're doing. There is no one offering the service out there. Yes, there's stock pickers out there, there's stock newsletters, and there's stock picking in itself is not new. But when it comes to trending stocks, using scanners to find trending stocks that are outperforming the indices, consistently updating you every single day, there's no one out there doing what we're doing, because ultimately no one's learned to do it. The industry is full of get-rich-quick schemes, day trading, and outdated techniques, value investing and tracker funds. No one is doing what we're doing, which is this trend following, this sweet spot of finding the best stocks and then rebalancing every 12 to 18 months. And then step 3, to how to invest in these stocks for maximum ROI, strategy execution. Again, we do this for you. So all you need to do is wait for the APL to be updated. You'll get the entry points, you'll get the stop losses, you get access to the positions that make it into our portfolio, and you simply wait for the notification and you copy along. So we're doing this for you as well. All you need to do is await our end of day notification, log into the APL because it's behind a members area, and copy the stocks that have made the final cut. The APL lets you profit from the same stocks we do, because ultimately, guys, that's what it boils down to. It just boils down to consistency of ROI and consistency year in, year out. This is a sophisticated approach. It's a professional approach. If you're gravitating towards the day trading, go ahead, do what you need to do. But I wouldn't just focus on that. At the very minimum, you want to be running these portfolios side by side. You want to have your trending long-term growth portfolio. And then if you feel you still want to day trade because you like the excitement and you have that hope that it will work, by all means do it. But you certainly don't want to focus on just one day trading approach. So we guide you from entry to exit for every asset that makes it into our portfolio over 12 to 18 months. Leave the stock picking to us and focus on the joy, and for some of you guys, maybe the relief of watching your investments grow. So, because look, let's not mince our words, guys. If you do not have this system, you won't have the growth that you want to have over the next 5, 10, 15, 20 years. This is the way to do it. Not only will you have growth stocks, you will be using a tax-free broker account offered by ActivTrades, and you'll learn to use spread betting correctly. That has to be your priority. How can I combine spread betting with trending stock consistently? That is where the money is. So the APL summary, we tell you when to invest for maximum ROI, saving you from missed opportunities. We do the scanning for you. We do find the assets. We save you thousands in scanner subscription costs and 1 to 3 hours daily. And we show you how to invest for maximum ROI, strategy execution. Ultimately, you'll copy our portfolio, improving your performance by many, many multiples. We do all of this for you. This service, guys, is £199 a month. But for ActivTrades attendees today, it's £7 for the first month. Come in, trial it out, get involved. There's a community involved. There's also bi-weekly videos involved as well. There's the bonuses that we're throwing in every Wednesday and every weekend. We add videos into the community so you know exactly which stocks we're looking at, how we're managing the portfolio. There's a community involved, so you're directly involved with me every single day. All of this good stuff, guys, for £7 for the first month. Get involved, get committed. It's a small commitment. If you want to stay with us, it's then £199 a month. Many of our community members are committing for the year, and they're getting a 25% discount as well. To get involved, go to the apl.sublimetrading.io link at the bottom there, apl.sublimetrading.io link, and please come through to our APL Academy. Okay, that is me. I think I am, not bad at all. 2 minutes to go. 2 minutes to go. Are there any questions, guys? I can see the organizers in here, but I can't see any questions coming through. So I don't know whether that is because there aren't any questions or because the questions are for the organizers only. So if you could just let me know if there are any questions coming through, guys. If you guys want to get hold of me, if you want to email me, you can email me at zaheer@sublimetrading.io. My first name, ZAHEER, zaheer@sublimetrading.io. You can connect with me on LinkedIn as well. Just search for my name and I will come up. I'm fairly active on LinkedIn. I can't see any questions. Organizers, are you there? I'll give it another minute. I think I've got another minute. We'll give it another minute, see if there are any questions come through, if the organizers pick anything up. As I said, if you have any questions, do reach out to me. If you want to jump on a call, you can book yourself in for a call as well. Just send me an email and I will get a Calendly link over to you. Okay. I can't see the organizers coming through. Well, look, guys, let's end the webinar here. I hope you found that useful. I hope that gave you an insight into a fresh, updated approach, something that's simple, it's sophisticated, it gives you control, it focuses on top trending assets in the market, combined with ActivTrades spread betting account. This is a winning combination. It's proven, and it's certainly something that you want to have at a very minimum in addition to your current portfolio. Okay, let's end it there. Have a lovely Friday, a lovely weekend ahead, and I look forward to having you all in our APL community. Take care, guys. Cheers. Bye.